Hi, everyone. Jim Curzan here. And this is the April economic and market review. We just finished the month of April. In fact, we're just barely in the month of May. As the old saying goes, April showers bring May flowers. Well, I'll tell you, April was stormy. The month of April started April 2nd, Liberation Day, where President Trump outlined his plan for tariffs. Not only tariffs, but the reciprocal tariffs on top of the standard tariffs. And the market got a bit spooked. In fact, in 5 or 6 short days, the market seemed to be down 12+%. Now, that was already on top of a fairly significant drop that we had the first several months of the year as well. So all of a sudden, the S&P was in bear market territory, and things were looking a little bit grisly. And then shortly thereafter, some of the tariffs got postponed. We're going to give everybody a 90-day reprieve. And as a result, the market has clawed up from a whole lot of that drop that we saw following Liberation Day. That said, the markets are still down for the month, as we'll see, and to a large degree down for the year. And a lot of the real concerns that we had going into April remain. The economy is showing signs of weakness. It had been doing that for several months prior to April, and the tariffs were somewhat maybe the straw that broke the camel's back. But it was certainly indicative of and kind of a reminder of just how quickly things can get kind of ugly. So here we are in May now, looking at the data that we just went through. Um, just a reminder, these opinions and views are those solely of myself. It doesn't reflect our custodian or, for that matter, the firm itself. I've been saying for many, many, many months now, actually probably better part of 2+ years, we follow the data. And that's been most confusing because a lot of the data has really kind of looked a bit ugly. And then you'll get bits and pieces of things that look somewhat bright. All this data should lead to one of two things. One, a recession. And as is typically the case, the data continues to weaken until it seems like the bottom just drops out and everybody runs for the exits. We saw a little taste of that in April. Or the data shows some signs of improvement, and it's more like a kind of a Nike swoosh. Regardless of how this thing ends, we were expecting some type of broadening out where the market's performance or lack thereof was more to do with the broad-based market and not just the Magnificent Seven or a handful of large cap stocks. For the most part, we have seen a bit of broadening out, although the month of April, we kind of saw that concentration again. We saw a big drop in Magnificent Seven over the first, let's say, 3+ months of the year, certainly the first quarter. And many of these were down 20+%. So we've got a bit of a pop in many of those names from their lows. And as a result, that was improvement, which kind of countered some of the general weakness we saw elsewhere. So we are back to, at least for the month of April, the Magnificent Seven kind of driving relative performance. On the economic front, again, follow the data until one of the two things happens. The data doesn't look great, and the macro data continues to weaken. The leading economic index for the month of March dropped again. It's been dropping now pretty consistently for better part of 2+ years. The drop in March, and again, remember, this is before tariffs, this is before Liberation Day, declined 0.7% in the month of March alone. That was a follow-up from a 0.2% drop in February. That's a fairly large monthly drop. And there's been quite a bit of consistency in this continued weakness. Credit card delinquencies, think of that as consumers, continues to show weakness. Through the fourth quarter, default rates exceed 11% on cards that are 90 days delayed. 90 days is a long period of time to just simply miss a credit card payment or some type of oversight. So there's something happening there with consumers and credit. Are they being tapped out? We're not quite sure. But since the economy is 70% consumer based, this is something we certainly want to watch. On the mortgage front, specifically commercial mortgages, we're seeing some weakness there as well. Office buildings, we're seeing a delinquency rate of just under 10%. That's 1 out of every 10 mortgages are delinquent. This is again on glass buildings, office space. And then in the multifamily space, we're seeing a huge rise in delinquencies there as well. Those are now just over 6.5%. And while that number is not huge, if we frame it by saying, hey, in the last year, that number has quintupled, it's increased fivefold as we were just barely 1.3% a year ago, it does show some signs of stress. Other things that we've noticed, home sales are starting to drop. The number of homes that are actually closing, some of that might be a function of high mortgage rates. And inventories are starting to rise. Remember a few years ago where home prices kept rising in communities because there just weren't homes for sale. And if you wanted to buy in a particular school district, in a particular neighborhood with, let's say, large trees or other amenities, you paid up because there was very little inventory. Well, inventory now has increased from a very low level, but it's increased nearly 20% from a year ago. At some point, that's going to affect home prices as well. And if that were the case, it should affect consumer confidence as we view our wealth or our financial standing, not only in what our portfolio looks like, but also the value of our home. CPI numbers have been a mixed bag. CPI rose a little bit. The core rose while the regular CPI number dropped. So there's not a lot going on there, but it isn't dropping a whole lot either, which is concerning since the target is 2%. ADP just reported this week that's payrolls. Think of that as employers reporting people they've added to payroll. And the number of new jobs created, new positions filled, that was 62,000. That compared to 147,000 the month before. So that was quite a bit of a reduction and quite a bit lower than expected as well. And then the last data point I'll suggest is, and again, this is a little bit of a mixed bag. The GDP number that came out also this week was shockingly low. It showed a drop in GDP, a contraction of 0.3%. That's compared to a 0.4% increase that was expected, which was down a ton from the 2.4% the prior quarter. Some of that may be front running on some tariff discussion, so we'll see what that looks like. But that number is certainly coming down, and whatever that number kind of trues up at, it's still probably much, much lower than what we saw just at the end of the year. So clearly we're seeing this slowdown in economic activity only being accelerated and volatility increasing as a result of tariffs. I won't spend a lot of time on this, but this is the other end of the coin. We have kind of this mixed bag of economic data that's certainly cautionary. And on top of that, we've got incredibly high market valuations. And when you have incredibly high market valuations, you don't really have an awful lot of wiggle room. There's not a lot there to blunt or defer weakness. It doesn't absorb a lot of weakness, and we saw a little bit of that with stock valuations dropping very quickly when it was surprised by tariffs. But just to give you an idea of what this looks like, this is a measurement of total stock market value to GDP, well in excess of 200%, very, very, very high by any standard, historic standards. This is called the Trump indicator. I'm sorry, the Freudian slip, the Buffett indicator. It is created by Warren Buffett many, many decades ago. And he would view a fair market at about 50 or 60%, not 200%. So this is a function of we've got Meg 7 with huge valuations skewing this market. And you can see where we are today, well ahead of where we've ever been, 67% ahead of trend line. That's problematic. And historically, when you've had these big moves, these big spikes in valuation, clearly you can see that in the year 2000, you've had a big, big drop in this ratio. Now, again, the ratio is stock market value to GDP. So if this thing is going down in value, it's going down in value because the stock market drop is overwhelming everything else. And remember, in math, if you're talking about a factor, numerator over denominator, and the denominator shrinks like the GDP is falling, that factor or ratio would actually go up. So you would generally see that blue line ascending and not dropping, as is typically the case when we get into these lofty areas. Getting into the weeds of performance, kind of looks like this. Second from last column is the month of April. Dow off 3, equally weighted S&P off 2.5, S&P off a bit over 1, down still 5% year to date. And remember, that's coming off of a lousy February and a lousy March. Again, way before tariffs. There's other things happening here as well. A couple of noted sectors. The international market is doing really quite well. It was up another 4% in April. That was following a 4+% move in January and another nearly 3% positive move in February. So it's up over 12% year to date. A lot of that is because of the weakness in the US dollar. And if we look at the third from the bottom, I'm sorry, no, that's not that. The fourth from the bottom, you'll see the US dollar dropped about 2.3% in the month. And it also dropped in March, and it also dropped in February, and it's down a little over 8% for the full year. Gold, as a direct result of that, is up. So even a balanced account, stocks and bonds, U.S. stocks, U.S. bonds, will be down well over 2% year to date. And a global balance fund with a little bit of international mixed in there would have been up a little bit year to date. Thankfully, because of the exposure to international. Without it, we would be down. One last slide on numbers, and we just do this because it's somewhat, I think it's kind of interesting to see how this all fits in. These are the Magnificent Seven. Again, I showed the performance of those firms in April. Remember, many of them have been down many months in a row. The weighting of those as of the end of April, by the way, those seven still represent 30% of the index. That's hugely inflated. The top 10 names represent just over 35% of the index. As of the end of last year, it was about 40%, which is still ridiculously high. To put that in perspective, during the dot-com bubble, if we went back to this slide, you'll see that big spike in 2000. Those valuations were certainly skewed because of many of those dot-com related companies. But anyway, back then, just before the bubble burst, before the air was let out, those large 10 names back then, the 10 largest, represented about 20% of the index, not 35. So that gives us a little bit of a perspective as to just how inflated some areas of this market are. Anyway, those 7 names were slightly positive on the month in spite of the fact that the S&P was down. So we are beginning to see this little bit of broadening out. So there you have it. That is the data that I've got to share with you for the month of April. We'll be back at it again in March, and in May, and we'll see what happens thereafter. A lot of economic data. We're going to see exactly what impact these tariffs, now that they're kind of alive and out there and kicking, what impact that has on not only economic data. Do we see a slowdown as a result of that? And also what impact it'll have on corporate earnings. Because with a market priced to perfection, there's not a lot of wiggle room to absorb bad earnings or the prospect of weakening earnings. So there you have it. Have a wonderful month of May, and we'll see you very soon. Take care.